Hello, today, in less than 5 minutes, KNG International Advisors will inform you about the international financial markets. This week's report is titled, The Fed Delivers, Markets Navigate Post-Cut Reality. The week culminated with the Federal Reserve's long-anticipated decision to cut interest rates by 25 basis points, bringing the federal funds rate to a range of 4.00% to 4.25%. Yet as Fed Chair Jerome Powell characterized the move as a risk management cut, markets delivered a nuanced response that reflected both satisfaction with policy normalization and caution about the path ahead. The S&P 500 dropped 0.4% while the tech-heavy Nasdaq fell 0.7% in immediate reaction to the announcement, a reminder that even well-telegraphed policy moves can produce unexpected market dynamics. This measured decline speaks not to disappointment but to the sophisticated way modern markets process information, pricing in not just the decision itself but the broader implications of Powell's accompanying commentary. What made this rate cut particularly significant was its context rather than its magnitude. The labor market is really cooling off, Powell noted in his post-meeting press conference, acknowledging the economic backdrop that made this move both prudent and overdue. Notably, newly installed Governor Stephen Miron was the only policymaker voting against the quarter-point move, instead advocating for a half-point cut, suggesting internal debate about the appropriate pace of monetary easing. The week's trading action before the announcement demonstrated markets operating at peak efficiency. The S&P 500 closed above 6,600 for the first time on Monday, setting the stage for what historically has been a favorable environment for equity performance. According to Morgan Stanley, the S&P 500 typically delivers strong performance during Fed cutting regimes, with the index returning 1.3% on average per month when the Fed is cutting rates. The broader economic narrative surrounding this decision reveals a central bank threading a delicate needle. Rather than responding to crisis, the Fed acted preemptively to support an economy that shows signs of cooling without breaking. This distinction matters enormously for market positioning, as it suggests policy normalization rather than emergency intervention. Technology stocks, despite leading the week's decline post-announcement, continue to benefit from structural growth drivers that transcend monetary policy cycles. The artificial intelligence investment theme remains intact, while the prospect of lower rates should theoretically support the elevated valuations that have concerned some observers. Perhaps most intriguing for future market dynamics is the $7 trillion wall of cash parked in money market funds due to years of high rates. As yields on these instruments begin declining with Fed policy shifts, the potential for significant capital reallocation into risk assets creates a powerful underlying current that could support equity markets through the transition period. The September seasonal headwind narrative, while historically valid, appears less relevant in this specific context. Just last week, the Dow crossed 46,000 while all three major indexes closed at record highs, suggesting that fundamental drivers are overwhelming seasonal patterns. Looking ahead, the key question shifts from whether the Fed would cut to how aggressively it will continue easing. Powell's characterization of Wednesday's move as risk management suggests a measured approach that prioritizes economic stability over rapid policy adjustment. This gradualist stance should comfort investors who prefer predictable policy evolution over dramatic shifts. For portfolio construction, this environment continues to reward selectivity over broad market exposure. While the immediate post-cut reaction showed some rotation away from technology, the longer-term structural themes supporting growth stocks remain intact. Meanwhile, sectors that have lagged, particularly those sensitive to interest rate environments, may find renewed favor as the cutting cycle progresses. The current moment represents a transition that markets have been anticipating for months. With the first cut now delivered, attention turns to the pace and magnitude of future moves. The Fed's dot plot and forward guidance will prove crucial in shaping expectations, but for now, the combination of policy support and continued economic resilience provides a foundation for sustained market performance. As autumn deepens and markets digest this new reality, the fundamental investment case remains compelling, a gradually normalizing economy supported by appropriately calibrated monetary policy. The test ahead will be whether economic data confirms the Fed's confidence in this measured approach, but Wednesday's decision marks a successful navigation of one of the year's most significant policy inflection points.